Hello, welcome to this video on portfolio analysis and in particular the Boston Matrix. So in this video we're going to look at what is meant by portfolio analysis, be able to explain the Boston Matrix and be able to apply the Boston Matrix. So let's start off with portfolio analysis, and that stems from the idea of a product portfolio. So few firms rely on one product. In this image here at the bottom we can see some of the products that Nestle have. A multi-product firm, the range of products is known as its product portfolio. Like you might have an art portfolio, but this is just the range of products that a business has. And most firms have a portfolio of products because it spreads the risk. Different products might be at different stages of their product life cycle, and so we can use a more successful one in maturity to fund one perhaps in development. Or if one is not doing so well, our budget value one, perhaps our high luxury brand is doing well if the economy is booming. We're going to look at a popular way in which we can analyze a business portfolio, and that's the Boston Matrix a little bit later on. Another way of looking at the product portfolio is to consider market mapping. And this is a diagrammatic technique that enables businesses to look at the existing products in the market by considering two variables such as quality and price, and then try and identify where there may be a gap in the market where their product might be. Now this gap wouldn't be particularly sensible because it's low quality and high price, but perhaps there might be a gap here for a high quality product that's just below the price of a nearby rival. So we can use this concept to analyze our product portfolio within the market, but we can also use the Boston Matrix to analyze our range of products as well. The Boston Matrix is a tool of product portfolio analysis which classifies products according to two things: the market share of the product and the rate of growth of the market in which the product is sold. And this was developed by a consultancy company called Boston Consulting Group. So let's make sure this definition is down and then we'll move on. So the Boston Consulting Group developed this way of analyzing your product portfolio, and essentially you place your products into a grid with four characteristics. And the axes on these grids correspond one to market growth, and here we can see the market growth in online game revenue, so that is how much is being spent across the market as a whole. And on the other axis, we have market share. So this gives us the example of market share in the UK grocery market. And effectively, it's saying what percentage of all the sales in that market does one particular business have. So here's our grid, our Boston Matrix, and we can see we have market share, high and low, for the particular products. And we have market growth for that particular industry the product is in, high and low. And so we have our products and we can place them under four categories. There are four labels we might use to describe our products. The first one is if we have products with high market share and high market growth, we call them stars. If we have products that have a high market share, but the market has slowed down in terms of its growth rate, we call these cash cows. If we have a product that has a low market share in a low growth market, we call these products dogs. And if we have a product that has a low market share in a high growth market, we call these products problem children. So which products do we want? Well, obviously we want really to have stars and cash cows, because these both are doing very well compared to the competition. They have high market share. What do we not want? Well, we don't particularly want dogs and we don't particularly want problem children. Why? Because they have low market share. They're not doing very well relative to their competition. We also have to consider this element here of market growth. Now, this is a fast growing market here, so we have to think about how we can compete in a fast growing market where we are trying to establish ourselves. These markets here, we'd say, are likely to be saturated. There is no growth anymore. So these products, the cash cows, are likely to be profitable, the dogs less so. So let's go through a little bit more detail, each of these categories. So let's start off with what a star product is. A star product has high market share in a high growth market. Let's just pause the video for a second, read through the characteristics of a star, and then take down some brief notes, and then we'll move on. So the key elements here is that there is fierce competition between firms in this market because the market is growing and other firms are likely to be entering it. So we're normally going to have a lot of promotional spending to try and establish these products and maybe increase capacity. The key reason we have stars is that we can hope they can go on to become cash cows in the future. We hope that they're really successful and they become cash cows. A good example here might be the latest iPhone. It's released into a competitive market. We have to fund it as Apple, increase our production capacity, but then if it succeeds and it beats all of its rivals, it's going to generate a large amount of profit for the business. The next one is cash cows. Again, let's pause the video, read through, take some notes, and then we can move on. So key things to note here that these are established products. They're probably in the maturity stage of the product life cycle. And the profits, a large amount of profit made from these products, hence cash cows, can be used to finance other products, such as stars or maybe problem children. You obviously want as many cash cows as possible. A good example here might be Amazon. They've established themselves as a key place to sell products and are making a large amount of profit. Okay, next let's go for problem children. Low market share in a high growth market. Again, pause the video, have a read through, take down some notes. Okay, the key here is the market is growing quite quickly. So it can be successful if we can establish it against its rivals, but something is not going very well here because we have low market share. So we need to be thinking about either we need to persevere with this product and give it a lot of attention, maybe in the form of marketing or designing it, which will cost time and money, or we might have to make a choice just to discontinue, stop with this product. If we continue with it, there's an opportunity we can turn it into a cash cow if it goes through the stage of being a star, but there is a big risk here that when the market slows and we haven't been successful, we end up with a dog. An example here might be the Microsoft Nexus 1. This was their competitor to the Apple iPod. And it was a high growth market at the time, MP3 players, but they had a very low market share. And despite spending time and attention on it, trying to market it, it was never really successful. And ultimately they discontinued with the product. Okay, lastly, dogs. These are low market share products in a low growth market. Again, pause it, take some notes, and then we'll move on. So to wrap up here with dogs, there is little scope for future profits because we've got low growth market and our product is not particularly popular. It doesn't mean we'll always discontinue the product. Some products can still be profitable if maybe this is a traditional niche, but it's unlikely that a firm will look to redevelop it or try and grow this product. They're more likely to concentrate on cash cows, rising stars, possibly even problem children, than dogs. The only decision with a dog really is to think about whether we stop this product at some stage. An example might be old-fashioned cassettes. Most music now is MP3, MP4, and digital. It's not a particularly fast-growing market, but maybe there is still a scope for a niche people who like the old retro hipster idea of having cassettes. So what is the purpose of placing your products into the Boston Matrix? Well, it's a good way of identifying which of your products, if you've got hundreds of products in your portfolio, to focus on. First question is, can the business develop a strategy? Can we use a strategy, corporate strategy, to turn the problem children into stars? And the second question is, how do we retain our stars as high market share so they become cash cows? Again, what strategy can we use, corporate strategy can we use to achieve this? Businesses should try to have products at different stages of development because today's stars are tomorrow's cash cows. So again, we can evaluate the number of products within each stage and also the strategies that we can use to try and move them round the matrix. A key thing to relate to here is we use this to identify products that we can then consider a strategy to maintain their status as stars, turn them into cash cows, or to deal with them as problem children. This theory does link back nicely to the product life cycle in terms of the relationship between them. At maturity, we're probably talking about cash cows, whereas in growth, we're talking about stars. Introduction might be, well, we don't know yet, could be stars or problem children. In decline, we may be thinking about dogs. So in this video, we've looked at what is meant by portfolio analysis. We've also looked at explaining the Boston Matrix and how we might apply the Boston Matrix to helping us with corporate strategies. That's it. Thank you very much for listening.